Henry, phase two, a lot of people have divided the pandemic into phases or stages. Mike Corbett, the CEO of Citigroup, calls the current phase stabilization. You call it phase two. What does it mean?
Yeah, and thanks for having me. Hope everybody's doing well. So what we at KKR have been thinking about is phase one was the kind of period where you had no fiscal and you had no monetary, and you could buy really high quality credits at very attractive prices. Same thing on the equities. That was more akin to what we saw in 2008. Phase two, we think, will be probably a 12 to 18 month period where you will have corporates deleveraging, because ultimately we think we're in a deleveraging cycle. And the second action item is we think that you're going to start to see some real acceleration of trends where you can get behind those trends. And you really need to think about kind of 2022 or 2023 earnings. And so we can spend some time on it, but there's some really important themes that are emerging. We view the pandemic beyond obviously the human component that we're sensitive to, as an inflection point for investors. And so there's some real themes that have emerged. I think you and I had talked about already, even before the pandemic, that 100% of corporate profits globally over the last decade had come from technology. That trend has probably accelerated, and there are several more that we're investing behind. And we're trying to look. Yeah.
I'm just going to interrupt you for a moment to say that before we get to the themes, I'd like to stick to some broader macro for the moment. Right now, we're showing our viewers a chart of the leading indicators. And as you know, this chart looks absolutely horrific. And people might be inclined to jump to some conclusions on the basis of that chart. Tell us, is the macro outlook improving or is it still deteriorating?
It's improving. We track data. We've got 175 companies globally. We operate in over 25 offices globally. And data is improving, led most by China. Ultimately, Erik, and I think it's important for investors to know, markets are discounting mechanisms, right? And so they're looking towards that improvement. You've seen that, one, in terms of some of the earnings revisions starting to turn up. You've seen consumption start to improve. And that's all good news. And ultimately, we're looking for more than 10 million Americans to come back to work by the end of the year. The bad news, unfortunately, is that the rate of change will start to slow, and we're probably going to be in a fairly slower growth environment. And so there'll be some destruction of demand that doesn't return. And I think, right now the markets have, what we think the markets are saying on the credit side, we think they're discounting in about a 9% default rate, and we think it'll probably be around 8%. So that's come in a lot since we last talked, when the market was discounting in about a 14% default rate. And on equities, what the market seems to be saying is that the multiple should be back to kind of pre-coronavirus levels, and that in terms of demand destruction, we're only going to lose about 5% of total demand. We think the number is probably closer to 10. So I think equities are right to rally on the fiscal stimulus. They've been right to rally on the monetary stimulus. I think from here, we probably appreciate at a much more measured pace. And we have to really, what's going to be the most important is getting the trends and the themes right. Because there are going to be some businesses that were over-levered and had bad business models that don't work. There are going to be some good companies with bad business models that firms like KKR help to repair those. And then there are going to be some that don't need any capital. And they just this is an accelerant to what they were already doing well.
Henry, people are asking themselves, can central banks, the Fed chief among them, put a floor under the market indefinitely, which is to say every time investors throw a tantrum, there's more stimulus coming, more liquidity coming? Or in your mind, is there a limit? And if there is a limit, where is it and when is it, as best as you can guess?
Yeah, that's a great question. I think there is a limit. Near term, we are seeing a shock and awe campaign. When you add up monetary and fiscal stimulus, both in Europe and the US, it's somewhere between 35 and 45% of GDP, which are extraordinary numbers. I mean, I've been doing this a long time. There's nothing like that we've seen. What will change investor sentiment around that, Erik, is a couple things. One is that money's not free, even though we have really low rates. So ultimately, there'll be some tax equivalent or some slower growth because of higher debt levels. And that will affect the rate of growth in terms of how personal incomes grow. And so that's probably the phase we're going to enter in 2021. The other thing, which you and I have talked about, is there's some tipping point on debt levels for governments. Our work shows it's about 150% of GDP, and we're getting closer to those levels. And so, I don't think we're going to see the bond vigilantes today, because the bond vigilantes are being overrun by the central banks. But ultimately, that liquidity spigot will turn off probably by 2021. So I think our view at KKR is the Treasury and the ECB and the Fed have done an extraordinary job. When you look at today's data that just came out that Bloomberg reported on, what did you guys show? You showed that personal income actually grew 11%. That's an incredible number, and that's all the CARES Act. The estimate was minus 6%. And at the same time, though, actual spending was down about 11%. So 100% of the stimulus of the income that came into consumers in America this past month was from the government. That's an extraordinary amount. And so the CARES Act and what's happened has really been a massive buffer. As we get to the second half of the year and into 21, I don't think, to your point, that you can continue to do this indefinitely. And I think that's why you're seeing a little bit of a pivot in DC and other areas to open up the economy, even though you're not seeing the rate of new cases decline the way some would want. And we can spend time on that. But ultimately, if you look at China, peak to trough cases took about 3 weeks. And right now, the U.S. is multiple weeks into it.
Henry,
and our data would still suggest about another 3 to 4 weeks to come down.
Henry, I'm jumping in because we will run out of time. Let's quickly talk thematically. You're bullish on credit, more bullish on credit than you are on equities. KKR just raised a $4 billion fund for dislocation opportunities. Not everybody has that luxury. For the mere mortals who have to invest in public markets, with IG up on the year, with high yield not far behind, where do you pick your spots?
You pick your spots in high yield. Certainly, that's one thing. The second thing is just get the themes right. The lesson from 2008 is that you need to understand what businesses are going to accelerate from here. There's a lot of value right now in the Russell 2000 in those. The S&P and the NASDAQ have moved up. So this has become an active managers market. That's what we're doing in opportunistic credit. That's what we're doing in our dislocation fund. I'm also very constructive on infrastructure. I think globally, you're going to see us be very aggressive around that. And I also think for those on the institutional side, there's real value on the private equity side, particularly outside the U.S., where the indexes are really dragged down by the banks. And you see that in Europe right now, where the European stocks, public stocks, are only back to the levels in 1999 when the euro was formed. So there's real value from active management, both equity and on the private side.